Hello, in this video, I would like to talk about beta coefficient and expected market return. In Capital IQ, if you just scroll down, you will see here beta based on 5 years daily stock price changes for Apple Corporation. And you can see the beta coefficient is 1.23. What does it tell you? So it's assumed that this is showing the riskiness of the company, and beta of 1 tells us that market itself, right? If you buy S&P 500, we assume that that represents market, or you can go, and some scholars use total market index, and that's the risk of market that has. But in addition to market risk, some companies have more risk, more volatility, or in other words, higher price changes. Some companies has less beta, which has less standard deviation or volatility over time. So obviously, Apple is one of those companies that has more risk based on beta coefficient. Again, some scholars argue that you may want to look at the industry average, you may want to look at competitors and so on. However, it's very hard to do it for Apple, I would say, and I think 1.23 is a good assumption. Why? Because if you look at the competitors, they have so many competitors, and it's really you need to do quite a bit of work and so many assumptions to be able to come up with your own beta based on the competitors and the markets that they operate in. So for example, if you just look at the Control F competitors, you can see that if you click here, you can see that Apple has so many competitors and they have different market caps, different industries, and so on. I think it is safe to assume that beta coefficient of 1.23 is a good assumption. So what I'm gonna do is go back to my Excel file, and I will put here beta of 1.23, and I will assume that this beta will continue in the future. Okay, including terminal here. Again, if you disagree with that, you can play with your beta based on your assumptions. And then next thing I would like to talk about is expected market return. Expected market return. Again, this is one thing that is also quite confusing. When you Google, you will find some people say 8%, some people say 9%, some people say 10%, and so on. I would like to do my own analysis. I don't like to trust other people's numbers. So what I'm gonna do is, again, I will go to my browser, and here I will click new tab and Google S&P 500 returns historical. And then here I would like to find the source that will help me to calculate this. So if I look at, for example, macro trends, 90-year historical chart could be an option. Let's click on this. And you can see here there are some positive years and negative years. And this is one source. And here I don't know whether they consider dividends reinvested or not. That's something that is very important, can make a big difference. Let me just search for another source where returns with dividends. And then here, let's see, let's take a look at this website to see whether we can. Actually, this website doesn't give us data. Okay, so this database is showing dividends in addition to prices. So I rather use this data. I've just clicked CSV file here. You can see slickcharts.com. You want to make sure that your data has the dividends included. So I will open the CSV file. However, as you know, you cannot really save anything on CSV file when you make calculations. So I will file, save as, I will save this as XLSX, save. And then what I'm gonna do here is I will make some calculations. So right click on row number 1, click insert. So this is my years. These are my returns. Now, what I would like to do is I would like to show what would happen if I invested $100. I scroll down, let's say here, 1925. If I invest $100, what would happen to my $100? Under Home tab, you can click on dollar. So first year I would get 11%, 11.6% return. So to be able to compound this, previous balance times 1 plus the return. But returns are not percentages here. To make the percent, you gotta divide by 100. 11.6%. All right, so you can see that my $100 became $111.62, another 37% growth. You can see that my money is growing. So right down corner, you can drag it all the way up. So you can see that my $100 almost 100 years ago would become almost $1 billion. So this is my, let's say, dollar value. Okay. So now what I would like to do is calculate the return or return on investment, annualized return on investment, ROI. So, but you can do every year, but instead of doing that, because as you know, stock market has volatility. Some years you will lose money, some years you will make money. So to account for that, I will consider the returns every 10 years for more long-term returns. So I will use Excel's rate function here. It's asking number of periods. I will just do every 10 years to see what's going on. PMT, I don't have periodic payments. Present value. So I will look at 10 years ago, 2019 minus 10, 2009. So I will assume that if I invested this much money, I will put invest, since I invest this money, this cash outflow, that's why I put negative in front of it. I would end up future value of this. Does make sense? So you invest $258 million, that became $923 million. Again, this doesn't have to be millions of dollars. If you invest $25.88, your money would become $92.30. Okay, so now I will assume that my payments are at the end of the period, and then I will guess that my rate is around 10%, which is 0.1. So you can see that 14%, this is compounded, this exponential return, meaning that if I make 10% return every year, in 10 years, 10 times 10, 100%, that's not geometric average. Basically, you will make more than 100% because every interest that you receive also receive interest. Okay, so you can see that last 10 years annualized, if I annualize, I will make annualized return of 14%. If I drag this one down or right down corner, black cross, double click, you can see that I can do the same calculations for so many years. Obviously, I need to have at least 10 years of data to start with, so I gotta delete these. So you can see now Control Shift up and Shift down. You can see count here. I have 85 examples. So these are all annualized returns for last 10 years. So someone might argue that, hey, what's the average all? So if I do average all since 1926 that I have, average of these, this is arithmetic average, Control Shift down arrow, press enter, 10%, okay. If I increase decimals, 10.39%. So that is the average return since 1926, compounded, okay? So someone may say, hey, last 100 years almost doesn't make any sense. But if I do average of last 10 years, all right. So what I'm gonna do is I will take the average of last 10 years. 7%. So it looks like the last 10 years were more disappointing, or actually 6.82%. What if I assume that last average of last 20 years? All right, then again, I will use the same formula, average, and I will go all the way till 1999. Okay, so now you can see that the average is around 8.48%. So now you can argue, what should I use? So I think you can use whatever you want, but I think most recent years, the returns are going lower and lower since interest rates are lower and so on. And I would like to use 6.82%. But if you think that that's not a reasonable assumption, you can use 8%. So I will use last 10 years of annualized return, which is 6.82% for my analysis, so which is 0, or in other words, 6.82%. I will assume that this will continue in last 10 years. Okay, last 10 years. Then terminal value, I will assume that overall 10.39%. So I will put 10.39% here. So in this video, again, we covered beta coefficient, which shows the riskiness of the company in comparison to the market, which is S&P 500, and expected return from S&P 500 based on historical data. That's it for this video. Until next video, enjoy valuations.